Pimco releasing its latest cyclical outlook, writing the following: at a time of sweeping geopolitical change and clear challenges for riskier assets, bond markets offer a source of stability. Tiffany Wilding of Pimco joins us now for more. Tiffany, a port in the storm. Let's talk about the storm, and the epicenter of that storm, as you and the team have indicated, is the United States and US policy. How dark are those clouds going to be tomorrow afternoon at 3 p.m.?
Well, I think just taking a step back, I think it's been incredibly clear what the Trump administration is trying to do. I think what's less clear is just amid the constraints, political, legal, economic constraints, how much disruption are they willing to tolerate? So we would argue that the three things that they're most focused on are reducing the trade deficit, reducing the federal government fiscal deficit, and of course, returning the middle class in the United States from its current hollowed out place. Now, those are structural issues that require structural changes, and the lever that the administration is pulling is increasing tariffs. So, they've been much more aggressive at every step of the way than I think most people expected, anyone expected. And we think tomorrow, similarly, we'll get an announcement that, has a similarly aggressive increase in average effective tariff rates in the United States to levels that we have not seen since the 1930 Smoot-Hawley Act.
Tiffany, do those levels stick, or is this the beginning of a negotiation?
Well, I mean, you have to believe this is the beginning of a negotiation. Obviously, there's a lot of uncertainty around that, and how ultimately that plays out. But I think we really just don't have a good sense, because we haven't seen this type of shock, in quite some time. Obviously, global markets are much different now than they were in the 1930s. It's difficult. There's the potential for what economists call, quote, non-linearities. Supply chains are much more integrated these days. And we saw that during the pandemic as well. And so I just think there's a lot of uncertainty around the economic effects if these things stick. And as a result of that uncertainty, by the way, we've argued that the bond market is a place where investors, can look to seek some stability in terms of their outlook for returns.
How do you start to think about what potentially this could look like when you start to look at each country and the retaliatory measures they may take on the United States?
Yeah, I mean, so this is certainly a multifaceted game, and that's, going to play out, over the course of this year. Now I think it's not only, the other countries' willingness to tolerate, some economic pain. Global uncertainty and trade uncertainty will impact every economy, but it's certainly on the U.S. side as well. Our economy, the U.S. economy is, as you mentioned, it's kind of ground zero for all of this. We've already seen, a deterioration in both consumer and business sentiment. I would argue that one of the reasons why the administration won was because people were, the price level adjustment that we've seen over the last several years. People are wanting a reversal of that. Obviously, we'll get more of that price level adjustment, some more temporary inflationary pressures as these tariffs are passed on. So I think there's some real political questions around how much or how long, the U.S. administration can tolerate this. And so I think that all of that, again, just creates a lot of uncertainty on ultimately how this will play out.
Tiffany, I want to pick up on something that you said, that you see fixed income as sort of a port in the storm, or something that could perform better than equities over the near term and potentially even the medium term. You wrote, markets are in the early stages of a multi-year period in which fixed income can outperform equities while offering a more favorable risk-adjusted profile. Can you explain your thinking at a time when some people are worried about stagflation, the idea that inflation could really pressure some of these yields and actually make a complicated picture for bond investors too?
Yeah, well, ultimately, starting yields within the bond market, high quality bonds are a very good indicator of where the 5-year returns can be. And just starting yields are actually quite attractive now, relative to, call it the last 10, 20 years. And so you can construct portfolios, with yield levels that are, kind of historically in the range of where average equity-like returns returns are. Then against that, you look at various measures of U.S. Equity valuations. You kind of pick your favorite one. Equity risk premiums is something that we like to look at. It's relative to bonds. And you just don't have. It's very tight. Looks very expensive. So we think even relative to its own history, relative to other asset classes, you can look to the bond market here. And I think the other thing is just within bond markets, diversifying and looking for opportunities outside of the United States. High quality areas within EM, for example, where you have a macro backdrop that is, also favorable for the bond market. That can provide a lot more stability and return potential. And if we do get a downturn in the United States, we've heard a lot about recession risks rising. You expect your bond portfolio to provide a pretty good hedge. So the bond market right now is sort of paying you for stability.
So in other words, you're saying that you don't see equities performing better than 4 to 8% on an annual basis for the foreseeable future?
Well, when you have starting valuations at these levels within equity markets, historically you have lower return potential, and again, and there's a wide distribution around those outcomes, right? It's less certain, whereas starting yield levels within the bond market, you're pretty certain that you're going to get that over a 5-year period.